Hi, and welcome to another episode of the Michael Yardney podcast. Now, we tend to talk a lot about property because I guess a lot of Australians are keen to invest in property to secure their financial futures. But the statistics clearly show that most of those who get into property investment fail to achieve their goals. Interestingly, more than half sell up in the first 5 years, and of those who remain in the game, there's only around 20,000 investors in Australia currently who've joined that 1% club who own 6 or more properties. 98% of investors own 1 or 2 properties. 20,000 only get to own 6 properties or more. Now, maybe that's because the market's rife with myths and misconceptions, which lead not only beginners, but also some seasoned investors. So today, I'm joined by Brett Warren, National Director of Metropole Property Strategists, to debunk some of these myths. So I'm sure wherever you are on this journey, whether you're just a beginner and you don't want to get into the same problems that these others do, or you're further down the track, I hope you're going to get some insights from my discussion with Brett. So, let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome, Brett.
Thanks, Michael. Yeah, well, look, there's a lot of myths out there. I'm sure we're going to go through a lot that people have heard today and maybe give a bit further clarification. So why don't we start at the top? And myth number one is that property investment is simple. And in reality, Michael, I've often heard you say property investment is simple, but it's not easy, and it's not a play on words, is it?
No, it's not. Look, many people start investing in property thinking it's straightforward. But when you look at the high attrition rate, how many people sell up within the first 5 years? And in fact, just recently, the latest CoreLogic Pain and Gain report suggested more and more investors are selling up within 3 years. And the fact that 92% of investors never get past their first or second property, I guess that reveals the true picture, doesn't it?
Yeah, it certainly does. That's what we've experienced as well. And I guess myth number two, Michael, is you make money when you buy property. And I know there's a very big focus on this because people always want to buy something, cheaper or below market value. And look, it's partially true because you obviously don't want to pay too much. But I guess at the end of the day, buying a bargain is a one-off bonus. And it's a real mindset shift. I listened to one of your podcasts the other day, Michael, and they were talking about Warren Buffett and how that compounding, he made most of his wealth in the last 5 or 10 years just because of that compounding. And that's something you really miss out on, particularly if you're just focused on that one-off hit and that one-off sugar hit.
Well, I guess what we're saying is the reason many people don't become successful investors is because they've heard these myths, people tell them about it, they've read about it, and they think they're doing the right thing. And it's partly true, as you say, because you do make your money when you buy a property, but not by buying it cheaply. That's a one-off, maybe a bit of a free kick. You make your money because you purchased the right property, an investment-grade property in a top location, one that outperforms in the long term. I've often heard you say to clients, Brett, that you can't change the location. That's not going to change. You can improve the property. You can even renovate it, refurbish it, pull it down, build new ones. But so it's a half myth, isn't it? You make your money by buying the right property at the right price, in the right position. And the right price isn't a bad idea if you can get it.
It's funny, I had a chat to someone the other day and we were talking about I could easily go and find them something, 5% under market value, but and they'd be very, very happy with this point in time. But in 10 years' time, if it hasn't grown in value, they're going to be disappointed. So
you've got to ask why you'd be able to get it under market value at the moment, Brett, when there's such a shortage of properties around. Good properties have a queue of people waiting for them.
Most definitely. Myth number 3 on the most common myths about property investing. It's something that you hear now and again, Michael, is that properties increase in value every year. And obviously, while over the longer term, historically properties have risen in value, but there's certainly some years where it's up and down. And, even some areas and some locations have decades without any property value increases.
Well, each state's at its own stage in its own property cycle, and even suburbs can vary differently. Now, I remember we've been working together around Australia, but you're based in Brisbane. There was a long period of time, a couple of years ago, where Brisbane really didn't do much at all overall, but then some particular properties in Brisbane, by choosing the right sort of property in the right location, did well. But it's really important to understand how property cycles work. And be prepared for periods of slow or no growth or falling back by having financial buffers to ride out time, not just buy a property.
I think that's very, very important, particularly those buffers at the moment. And I think that's going to be very important, obviously, at the moment, Michael, where we've got interest rates rising and cost of living rising, that you really need to buy that time, don't you?
That's right. I think following on from what you said a second ago, one of the myths is that property values double every 7 to 10 years. And on paper, that looks good, but it's far from universally true. Now, we've got our statistics that we work at through our research department going back to the middle 1980s, which is the longest the Australian Bureau of Statistics and the REIA have been able to give property statistics for. So how long it takes to double really depends a bit upon when you start and when you stop your measurements, because you can make it look better or worse. But over that time, in general, Sydney, Melbourne and Brisbane, Melbourne's outperformed the other two states just a little bit, have grown around 8% per annum. But while some, which means they've doubled in 7 to 10 years, but that's an average, which means that half of the properties have grown faster and half haven't doubled in value. I guess that's how averages work, Brett.
That's right. And I guess that leads on to our next myth as well.
Well, maybe we should just go back to also regional properties. They're not going to grow as strongly, in general, have had a boom in the last little while around COVID, as most capital city properties either.
And also, I guess, Michael, those newer areas, those newer locations where you see a lot of physical growth at the start, and they start off with quite a lot of growth because there was not a lot of houses there 2 or 3 years ago, and all of a sudden you get this huge amount of physical growth, and it's quite common to see that, but then the next probably 7 to 10 years is actually quite flat.
Definitely. Sure. So that's where a lot of young first homeowners go, and you can understand that they've got to go to those outer suburbs that were farms a while ago, and so therefore the statistics can be made to say almost anything, and so values have increased there, but often the nature of the property has changed, and then all of a sudden they will remain flat for a long period of time.
Myth number 5, Michael, and obviously property can be a pretty forgiving asset, but the myth is that all properties make a good investment, and this is a pretty big call, and many people enter the property market with the assumption that, any property can become a golden goose, I guess, which is a bit of guesswork, but, they want to look for those financial rewards, but it's very, very far from the truth, isn't it?
Well, there are 11 million dwellings in Australia. At the moment, the total value of that's up to $10 trillion. In other words, we've actually virtually got back to all the losses that happened over 2022 have now come back according to CoreLogic and also to PropTrack. And of course, any of those 11 million properties could become a property investment. You just kick the landlord out, put a tenant in, and you've got an investment. But that doesn't actually make it investment grade. To us, an investment grade property is one that's going to outperform the averages in the long term with regard to capital growth. And that's, I guess, partly because of its location, because of its land to asset ratio, its intrinsic value, its scarcity. So what else do you think makes those better investment grade properties?
Well, I guess with every investment, it comes down to demand and supply initially. And obviously, we're looking for areas where there's really, really no supply left. You can't just build another 1,000 houses or put up another 1,000 apartments. But there's huge demand from major job hubs, significant job hubs like CBDs and airports and hospitals and schools and things like that as well. And I guess the locations we're looking for appeal to a wider range of, I guess, the more affluent owner-occupiers. They're looking for the right areas, the right locations, as I said before, close to good, really, really good schools, lifestyle amenities, water, I guess, is an ideal situation, cafes, shops, restaurants and parks. And that's something that also, funnily enough, appeals to a wide range of tenants. And those types of markets were very resilient, I guess, during the downturns and particularly during the COVID side of things. And I guess on the flip side, a non-investment grade property, I guess what some call investment grade stock, I guess have the opposite characteristics, don't they? They're located in areas with fewer employment hubs and growth drivers, so there's a lot less demand. And because there's a stage 2 or a stage 3 or another tower going up, there's significant oversupply issues, and we've seen that with many of the Lego land kind of towers, haven't we, Michael? And those areas, I guess, lead to stagnant capital growth. Initially, they're probably paying a bit much over anyway for those over and above costs. The premium that they're paying, and it takes longer to kind of grow. So it's not just about owning the right kind of property, it's about owning the right kind of property and getting it in the right location. So obviously making sure you're not just grabbing it just because it's in your budget, but make sure it has all those features of that make a long-term solid investment.
Well, right at the beginning, we gave the statistics that most investors fail. They fail to build a portfolio that they're wanting to achieve. And I guess that's because not all properties make good investments. I think another myth is that property investment is fun. We see people getting excited. They love the research. They love the open for inspections. They like the negotiation, or maybe they're not that keen with that. They see it as an exciting venture but that tends to lead to emotion and emotional decision-making. In reality, in my mind, property investment should be boring so that the rest of your life can be exciting. I often say, if you want excitement, go bungee jumping, go trail bike riding. Your investment decision should be based on evidence, numbers-driven, focused on long-term gains. In my mind, emotional's got little place for investment success. Now, we help a lot of home buyers as well as investors at Metropole. And home buyers are allowed to feel emotional about the home. They're meant to have their heart smile, their eyes smile when they come home, their hearts sing when they drive down the street. But they shouldn't get emotional about the numbers and figures. And that's why it's really useful to have a home buyer's agent on your side, a buyer's agent protecting you from that side of the property transaction.
Yeah, we see that emotion shouldn't get in the way. As an investor, we often get people that get emotional and can't see themselves living in that property or something like that. And then as a homeowner, as you kind of said, people make emotional decisions. And maybe they love the house, they've fallen in love, they haven't seen something like it for 6 months, but it's on a main road or there's some flooding, and they let that emotional side of things take over. So I think you're right, Michael. If you're getting emotional and you want fun, maybe go for a paraglide over Switzerland or something like that.
You saw the video.
Yes, I did.
Look, one of the things I've come across over the years is most people invest close to where they want to live, close to where they want to retire or where they holiday. They invest in their comfort zone, and that's a myth because it's said that if you invest in areas that you're familiar with, then you're more likely to get it right. Interestingly, that's not the case. Just because you live there or like to live there doesn't mean it's a good investment location. I remember a number of years ago, there was a study done in Australia by two separate universities, one in Tasmania, one in New South Wales, and they combined their statistics showing that people who invested in their comfort zone in their own backyard, where you think they would have a natural advantage, they'd actually have an idea of what's going on and how to invest. Interestingly, their long-term statistics showed they actually didn't get it right. They didn't do as well as people who didn't necessarily invest in their comfort zone, but acted on evidence. Now, we're seeing that a lot at the moment also, that our more strategic investors are not necessarily investing in their comfort zone or even in their own state. There's a lot of borderless investors nowadays, aren't there?
Yeah, there certainly is. And I think that's obviously got to do with technology and the internet and things as well. And one thing you did mention before, Michael, is a lot of people, I guess, in maybe their 30s and 40s, and they want to live on the Gold Coast or they want to retire somewhere in 20 years' time, and they go and buy a property in Townsville or the Whitsundays or something. But in reality, that money could work a lot harder for you. And I guess in 20 years' time, you might even be able to go back and buy two of those particular properties if you've got a more efficient type of property and it's worked harder for you and had that compounding and growth and leverage we spoke about.
Well, the myth is that you should invest in your comfort zone, but the mistake people make, as you said a moment ago, is a separate one where they're actually trying to get the property to do two things. How often do we hear people say, hey, I want you to help me buy a property in Melbourne or Sydney because my son, daughter's going to university there, so I'd like to buy an apartment rather than pay rent. We talk them out of it because otherwise they'd buy something that is unlikely to outperform, often a one-bedroom apartment close to the university. I'd rather pay somebody else rent and spend my money on an investment-grade property rather than trying to make a property do two things at the one time.
Yeah, it's that short-term focus, and it could be literally hundreds of thousands of dollars. We've done the numbers, even on a 1 or 2% different capital growth over a 10 or 20-year period. And it is quite substantial when you measure it out and you play it the long game.
Sure. So let's go through a few more myths, Brett.
Well, look, myth number 8 is something I get not all the time, but property investment is a get-rich-quick scheme. People are in it for a short, quick profit and to flip something and buy something and make $1 million and continue it on and really kind of trade that time for money. But in reality, Michael, property is not like that. Property investment, particularly in Australia.
Well, interestingly, I get the same emails in my inbox that you probably do, which perpetuates that myth. They say, hey, you don't need money to get into property. That's not true. Actually, that's another myth. I'm not sure if that's on your list. They say that you can get rich quick, you can flip, you can take advantage of people who are having to sell at the moment and not even get any money and flip and make. Last week you were flipping hamburgers, now you're flipping properties. No, it doesn't work that way. It's usually a journey of 25 to 30 years to reach financial independence through property. Brett, it's a marathon, not a sprint. Look, I've owned for 10 years. A lot of investors make mistakes. They learn what not to do until they find a strategy that suits their goals, their budget, their risk profile. In fact, I think they should get rid of that first 5-10 years of loss by getting a good team around them who are going to share a good strategy with them. But anyway, that's the first stage. The next stage is the asset building stage. And if you could miss those first 5-10 years, you'd cut the journey down. But you still need a couple of good property cycles to build a substantial asset base. And only then can you slowly lower your loan to value ratio. So initially you've got to borrow, you've got to gear, you build a big asset base, then you lower your loan to value ratio. And then eventually you can live off the cash flow of your properties. But sometimes you actually need more than just property. In fact, a lot of our clients find that they've got to have a balance of a own home with no debt eventually, a residential real estate portfolio, superannuation fund, and something else to bring a level of cash flow in, whether it's commercial property or shares or other things. So it's not a get-rich-quick scheme. It's a planned financial journey.
Yeah, look, I also think that people underestimate the in and out costs, don't they? The stamp duties and the capital gains and the agent's costs, and they think they're going to make a clear $50,000 profit. And in reality, it turns out to about $10,000. It's probably not worth all the effort that they've put in when they could have just held.
And they've got to start all over again.
That's right. Something we hear all the time also, myth number 9, is that there's one Australian property market or Melbourne or Sydney property market when, I guess the media frequently talk about the Australian market. Each state has its own cycle. But as we just said, even within states, there's sub-markets. And even within suburbs, Michael, we often talk about your suburb and my suburb as well. There's differences in locations and performance and things as well. Isn't that right?
So the property market is a mosaic, not a monolith. But interestingly, only a couple of days ago, I was interviewed by a journalist in the media who asked me, tell me how the Australian property market's going. The first question. And I love that question because I say, there isn't an Australian property market. And then I went on to say exactly what you said. So, yes, there are big general trends, but if you want to be successful in property, you've actually got to get down to a granular level, don't you? Even in some cases, one side of the street is different to the other.
I live in a similar area to where we work. I'm in Clayfield in Brisbane, which is a great location. We're here at the moment. It's a fantastic suburb, 5 k's from the city, 3 or 4 k's from the airport. But we only actually buy in 30% of this suburb because there's some flooding, a couple of main roads and a train line. There's some zoning issues where you don't want to wake up one day and have 100 apartments behind you. And we just want to get into those nice, quiet, tree-lined streets. And those areas can perform significantly different over the longer term. So you do have to be very, very wary.
Another myth that people unfortunately fall for is that all properties increase in value over time. Now, we said a moment ago that a myth was that they increase 7 to 8% per annum, but unfortunately, not all properties even increase at all. Some properties stagnate or even depreciate. Now, we talked about regional markets and mining towns, not big regional markets. They tend to be much more highly volatile, though the smaller ones, they're risky for long-term investments. And even some secondary capital city locations have had stagnant growth for long periods of time. I came across a property that our research team was looking at and pointed out to me was an apartment that somebody, fortunately not one of our clients, bought 10 years ago in Sydney for $465,000, and today it'd be worth about $510,000 after 10 years. Now, Sydney's done really, really well, but this is in a poorer socioeconomic working class area of Sydney that has got a bit of crime and other issues associated with it. So even in the capital city of Sydney, this particular property hadn't gone up in value at all over a decade.
It's amazing. And we've probably seen that in Perth too, haven't we, Michael?
Perth,
in the early 2000s,
yeah.
The huge amount of growth there, and it's done very little since. And I think Perth probably a little bit of trap in the short term, Michael, isn't it? Because it'll probably likely happen again over the next couple of years. There's going to be some really good growth there. But what happens after that, I guess, is the big question.
That's right. So you need multiple growth drivers. So why do some properties not increase in value over time? Well, again, not all locations are created equal. Even in our good cities of Melbourne, Sydney, Brisbane, all the capital cities, there are those desirable locations which the more affluent locations, it's a bit like the Monopoly board, isn't it? Everyone wants to buy Mayfair and Park Lane. You don't win Monopoly owning those purple ones down the other end of the board. We actually we don't particularly buy in those more expensive suburbs because even though the land value is very, very high there, but maybe they're not as affordable. And on the other hand, yields aren't as strong there because the properties are more expensive. But we like to buy in aspirational suburbs where people wake up in the morning and want to live, and more affluent people are moving in and the suburbs are gentrifying. Then, of course, there are all those affordable locations, and people say buy in affordable locations, but they're the ones, like you said a moment ago, the new suburbs in general that often for long periods of time don't go up in value. And the fourth of the four different types of locations, those last ditch locations where people live because they've got no choice. People don't wake up in the morning wanting to live there. So I'd be very cautious about location, knowing that that's going to do most of the heavy lifting, and then buying the right property in that location. Because as you said, the myth is correct. Not all properties increase in value over time.
Yes, now let's get on to the next two. They're probably linked in a certain way, but I guess when it comes to property investors, there's obviously two really conflicting philosophies you kind of hear about. Let's deal with myth number 11, which is negative gearing is a surefire way to profit.
Well, I think a lot of accountants recommend that to their clients, maybe not necessarily correctly. I know around the end of the tax year, we often get a whole bunch of people coming and saying, I need to buy investment property. My accountant says I've got to get negative gearing this year. I'm paying too much tax. Negative gearing isn't a strategy. And in fact, a property isn't a negatively geared or a positively geared property, is it?
No, it's not. It's absolutely got to do with the way it's financed.
Sure. So if you don't borrow at all and you get income in, every property's got positive gearing. On the other hand, if you borrow 100%, almost every property is going to be negatively geared. So really it gets back to understanding why you're investing. And I think that people talk about cash flow and capital growth, but there's also another element that sometimes they forget, and that's risk. So when you're investing, you can usually only get 2 or 3 of those. It's really hard to find a low-risk property that's got high cash flow and capital growth. So if you want cash flow, in general, you've got to forego capital growth. But if you do the numbers and figures and you want to have a substantial asset base that one day is going to give you choices in life and freedom, you'll never get that through savings, and you'll never get it through cash flow, which is taxed. You need to have capital growth, and in the short term, forego cash flow.
Well, it's interesting, isn't it? Because if you'd had invested purely for cash flow about a year ago and you've had about a dozen interest rate rises, all of a sudden that's gone, and you're probably stuck with a property that is high risk. It's going to be difficult to sell, and it's probably not going to be growing in value either. So you're 100% right. Those kind of considerations around cash flow and holding costs, they're secondary considerations. You've got to get the growth and the capital moving in your favour, don't you?
Now, interesting though, if you've got a high growth property, in general, the rents will go up as well. Now, at the moment, rents are going up for every property because there's a real shortage of properties. And in general, capital growth and rental growth don't happen in unison over a period of time. Capital growth goes up and then all of a sudden rents go up. And so in the future, your income that you're going to want to live on in your golden years when you live off the cash flow of your property portfolio will be dependent upon your tenants' ability to pay more rent. So you want to own the sort of properties in areas where tenants aren't a week or two away from broke, and that's in general the more aspirational affluent areas rather than the more affordable areas, which tend to be where you get the cash flow properties. But that brings you to the next myth, isn't it? That cash flow is king, because a lot of people will say that. It's important to understand that property is a game of finance. And it's got some houses thrown in the middle, which means cash flow is critical. I don't think we're suggesting it's not. We know that how many people, unfortunately, very few of our clients have got themselves into trouble during this period of higher interest rates in Australia because we've got financial buffers in place. So we do understand cash flow is critical to keep you in the game, but it's really capital growth that gets you out of the rat race, Brett.
I think you always talk about understanding the rules of the game as well, Michael, and understanding, we get a lot of people that it doesn't transfer. Our market's different to the UK and the US. understanding our market, and in Australia, residential real estate is really a high growth. Look, it's relatively a lower yield investment. So your aim as an investor should be to build a substantial asset base first. And I think that's where people get it wrong. They're trying to trade cash flow for their job. They want to quit their job and walk away with 100,000 and create that cash machine. But you mentioned before, it can take decades to do that and compound and leverage. So we always advocate for buying those growth properties first, and then you can get the cash flow once you've got that substantial asset base by reducing your debt, bringing into consideration maybe some savings or some shares and things we kind of spoke about before. I guess many investors are looking for that cash flow short term because they're thinking about the here and now rather than the longer term. And
that's right.
Buying properties that, I guess, solve that short-term problem, but it won't give them long-term financial freedom. And you've already mentioned people looking for holiday homes and also people looking maybe for their kids' university or something like that. It's trying to solve a short-term problem, isn't it?
Sure. So there's no doubt that you've got to be able to service your debt with a level of rental yields, but you can actually buy a couple of years of time by having financial buffers in place so that you're not negatively geared. You're actually eating up your buffers. Now, that's a advanced finance strategy, but at Metropole, when we see our clients, even before we talk property, we put a strategic plan together. We're much more than just buyer's agents. We help our clients safely grow into generational wealth through strategic wealth and property advice. And that involves a strategic plan, but it also involves a finance plan to see them through, as well as the right asset protection strategies. And we've got at Metropole, as I'm sure people by now know, renovations, development, property management, and through Mark Creedon and Caroline, our Business Accelerator Mastermind program. So there's lots of ways our team at Metropole can help you. So rather than falling for these myths, and we've got a few more that Brett and I want to discuss, if you want to take advantage of the new property cycle, it's not too late to take advantage of this property cycle. Sure, it started earlier this year, but we're still at the early phases of it. Have a chat with the team at Metropole. I think what's going to happen shortly, Brett, is now Australia's property values have ended up catching up to making up all the losses, and the headlines are now going to be that Sydney's reached a new peak, Brisbane reached a new peak. At the moment, the headlines are saying this particular suburb has, that has, and when people read that, they're going to feel, hey, I've missed out.
And as we know, Michael, it's probably 2 or 3 months behind, isn't it?
Yeah.
It's already happened, so it's definitely too late if the media are reporting it. And I'd suggest it's a good time, as you said before. Maybe it's not a good time to buy for you personally, but I definitely think it's a good time to understand how you'll place and what may lay ahead, and how you can take advantage of that. So
if you want to find out what your options are, why not have a talk with one of our wealth architects at Metropole? Go to metropole.com.au. I'll leave a link in the show notes, and it's obligation free. Let's see what we can do. We'd love to work with you, and if we can't, we'll honestly tell you that as well. Now, as we go through this list of myths that you put together, Brett, one is that you should always follow the crowd because it's safe. What do you think about that one?
Well, in terms of obviously the investment side of things, and a lot of people do get caught up in the hype and following the crowd, and quite often, as we just said, it's done in arrears, so they don't really understand where they are in the cycle or where they are in the market, and putting your hard-earned money into where others are
FOMO, isn't it, Brett?
Investing.
Hey, they're making money. They've made money. I want it too.
It is, and they're always late to the party, and I guess that comes back to having an evidence-based approach. And we spoke about taking emotion out of it, but I think there's nothing wrong with following the crowd in some respects, particularly if you're looking for, known and proven long-term fundamentals and areas that people will continue to work and continue to want to live in and things like that as well. But I guess people, who are crowds who are flocking to a particular suburb or town or development doesn't necessarily mean it's safe or suitable for you to invest there either.
Well, we're all playing different games. So the level I'm at is different to what beginning investors are at. You're at a different level than you were 15 years ago when you first started investing. So be careful who you're taking advice from and make sure you're playing the right game. So the sort of properties that you're investing in today and Abby are very, very different from when you first started. And so much the same here. Just because others are doing it doesn't mean it's right for you. Research and due diligence is important. That should be what dictates your property investment strategy.
Most definitely. We talked about a bit the next myth, Michael, which is a little bit about you should invest mainly for tax deduction, but kind of wrap that up in the negative gearing. And I guess from my point of view, that's really just the icing on the cake and a consideration we can factor into your personal plan. But it really has to be about capital growth. That has to be the primary reason to invest. And if we can work and strategically look at your your situation and include, tax deductions, depreciation benefits, negative gearing, then that's really just the icing on the cake, isn't it?
It is. So you shouldn't invest solely for tax benefits, but as you say, they're nice to have. Now, one of the myths that a lot of Australians have, and I see this with some of the trolls on YouTube who are going to listen to this because this podcast also comes out on YouTube, and they make comments, is that debt is bad. There's never been as much information about how to become financially fluent as there is today. However, I think there hasn't been as much financial misinformation as well, like debt is bad. Yeah, bad debt is bad, but using productive debt that allows you to buy income-producing properties that increase in value, Brett, in my mind, that's a smart strategy.
It is. Why not use other people's money? I think that's a good trick with property as well, Michael, isn't it? We use more of other people's money. We borrow money. We take on debt for good purposes. We're not, buying cars that are depreciating and things like that as well. So I think that's something you can use to your advantage, particularly with property investing. And I know, the poor and the lower socioeconomic are probably a bit more scared of debt because they don't understand the financial fluency and how to repay it or how to pay it off. And they've always got to have a goal in mind of paying it off and getting rid of it as quickly as possible, which we see a lot. But that's not necessarily the case. The wealthy and the successful do things differently, don't they?
Well, yeah, they recognise that debt isn't a problem. Not being able to repay it or pay the mortgage is a problem. And on that basis, they've got a financial plan. And that's, again, part of the financial strategy that we put together for our clients at Metropole. Now, another myth, a lot of people go in, the beginners go in looking at open for inspections, and they think the selling agents, the real estate agents on their side, but they don't recognise that in general, well, not in general, in all cases, agents are primarily representing the seller's interest, not theirs.
It's a good point. What do they say? Follow the money, Michael.
Yeah,
as well.
Where they get paid, how do they get paid?
That's right. Clearly, they provide valuable information, and obviously, about the area, the location, the property. But you've got to remember that, like I said, where they are being paid, and their primary goal is to secure the highest possible price for the seller. So they're going to do all that they can to do that and get the highest price possible as well. Sure.
So it's probably better to level the playing field. In fact, tip the scales in your favour by engaging a buyer's agent to represent you. Got to be careful, though. Not all buyer's agents are the same. I read a really interesting article or blog it was a graphic on Instagram by a good experienced buyer's agent in Sydney, Veronica Morgan, who said, would you give your keys to your Porsche to a P-plater? And I guess what she was getting at was, would you actually entrust the purchase of your home or a very expensive investment property to an inexperienced buyer's agent? So the buyer's agents at Metropole have had many, many years of experience, and almost all of them have been selling agents in the past, so they recognise the game, they know the language, they know the tricks and the traps. I mean, the selling agent knows 5 things about the property that they're selling that you should know, but they won't tell you and you probably don't know. So you've got to understand how to elicit those by asking the right questions or doing the right due diligence. Now, another myth, and I think it's getting less, but the media and the blogs would suggest, the emails, the selling agents, the marketers would still suggest it's the case that new and off-the-plan properties make good investments, Brett.
Yeah, look, it's such an easy sell, really, isn't it, in reality? Yeah. I mean, some of the properties we buy, Michael, another one we bought for you, remember? I know we were going to knock it over and build 2 new properties, but could you imagine me trying to sell that to someone? It's an absolutely horrible-looking thing, but the purpose was obviously to develop it. But it's easy with off the plan because it's all brand new, it's shiny, it's incredibly tempting. They've got the saunas and the gyms and the spas, beautiful modern designs, great furniture, and then you've got the tax depreciation benefits and the rents and things like that as well. But those things don't necessarily make good investments, do they?
No, they don't, Brett. Firstly, there's a long history of many of the new and off-the-plan properties. The towers are having lots of building problems, being secondary type of properties. I think in the long term are going to be the slums of the future. Then in most of those buildings, the majority of owners, the vast majority of owners are investors. Imagine the owners' corporation meetings, Brett, when they say, hey, we've got to bring in some extra money, we've got to fix that, we've got to do that. When in fact, a lot of the owners haven't got the money to do it, and many of them are overseas and don't even turn up to the owners' corporation meetings. So other things I've noticed is that when they actually purchase the property, the value on completion very rarely meets the prices they said in the sales pitch in the glossy brochure, that means that they've got to find even more money to settle. You don't normally get what you were expecting. Properties often don't have exactly the same floor plan. They're allowed to. The builder's allowed to change things or sometimes change the fitting. So I don't think we really have to go any more than this, other than to say new and off-the-plan properties very, very rarely make good investments. There are exceptions. There are some good quality new properties in the way of townhouses or big apartments built for downsizers. So if you find a townhouse in a group of 2 or 3 or 5 sometimes, or some of those better quality, expensive apartments in downsize locations, that they could work out okay.
Yeah, absolutely. And you quite often find the growth from those properties have come from the market rather than the actual property itself, because it's been 2 years later. So it's got a lot to do with that. The other thing, myth 17, which we can dispel, I know it's we talked a little bit about the nice, shiny new places, but a lot of investors think older properties are really just money pits. And, they obviously require more maintenance. They come with, obviously, different land sizes. There's established neighbours. There's different architectural features as well. You can prevent those types of things. Having a building and pest report, understanding heading in what the limitations are, if they are going to be a money pit. And potentially sometimes that's what people, when they get emotional, they don't do those kinds of due diligence and checks, do they?
No, exactly right. So as you say, they come with the advantage of the bigger land size, often good neighbourhoods, unique features. But on the other hand, yes, they will require a bit of maintenance. But we actually like that concept of buying an older property that you can do some renovations to, not to sell, not to flip, but a couple of years down the track when the tenant moves out, you may want to upgrade the kitchens, the bathroom, the carpet, spend a bit of money and get good bang for bucks and a wider range of tenants looking at it, as well as some depreciation allowance. So you've got to have the right bones, though, so it's got to be structurally sound, as you say, and that's what a good building and pest inspection will find. And I know that often our team avoid certain properties, the buyer's agents avoid them, but when the building and pest inspection is too negative, or sometimes you can use it in your favour to negotiate, Brett.
Yeah, particularly if they're just minor things that can be repaired. And like you said, it's clearly not a money pit. It's 1 or 2 items that you can remedy, and we can get a benefit of that, then it's not an issue. Right.
So when we talk about finance, one of the myths is go for the lowest interest rate. I know that a lot of people, when we refer them to one of our finance strategists, say, well, how much interest am I going to have to pay? What's the best rate you can get me? And as we've said, probably is a game of finance with some houses thrown in the middle. But strategic investors have a finance strategy. They've got the financial buffers. Boy, we've said that a few times. And sure, the lowest interest rate can save them money in the short term. But in my mind, there's lots of other factors to take into account, including features and flexibility, because your needs and your requirements may change. So that's all part of having a financial strategy.
Yeah, I think, Michael, you also have to treat it like a business, don't you? So I think the key thing you said there is flexibility, having the ability to transfer some capital. Maybe you have to put down another deposit. Maybe you have to, do a renovation. You can withdraw some of that equity. If you're locked into the best interest rate, that's not particularly going to help you.
Doesn't always work. Sometimes it's worth paying a little bit more, but having a bigger borrowing capacity, being able to borrow more. Okay.
And that's why you need someone at a higher level, not just a bank or broker.
Well, I wouldn't be going directly to banks because they don't understand what's required. You'd think they would, but they don't understand what an investor requires. Now, the last myth that you've got on this list here, Brett, is I'm too old to invest. It's too late for me to invest. What do you think about that?
Look, it's certainly towards the back end of the cycle, I guess, but what people have got to realise is that the age of staying alive is getting later and later, 70, 80, and who knows what it'll be in another 20 or 30 years. So it's not too late. I still think there's time there. Clearly, there's another property cycle involved, but it's also about, I guess most people at that age are also thinking about building and leaving a legacy for their children and grandchildren. And a lot of our clients we see do that. So it's not just about, I guess, buying a property and hoping it works out in 5 years' time, because you've also got those other additional benefits such as your super and your shares and maybe inheritance and things like that as well, which can really buy you time. We spoke about buffers, and we talk about these types of things that can actually buy you time to get through a property cycle or two, allow the compounding and the leverage and the growth to work. So Yeah, I guess never assume you're out of the game just because of your age or your finances. And I guess that's something that we help with a lot of clients with, and that strategic approach.
Definitely. So while you may be out of borrowing capacity, and we're not allowed to give advice on superannuation, but some of our clients have got the option to utilise a self-managed super fund, which has totally different borrowing capacity to you. It's totally separate. So you may be maxed out, but in fact you could buy a property there. Again, it depends on what your age is. You don't want to go into your golden years with a large amount of debt that's going to hang over you, but there's options. So I guess the bottom line is never assume you're out of the game because of age or finances. Brett, we've gone through a whole lot of myths, and I guess what I wanted to do was allow our listeners to get a balanced perspective from people like you and me who've been around a while, seen these myths, and realise they're not correct, because they can lead you astray. So keeping your eyes open, being supported by facts, having holistic strategies, being well informed, and getting a good team around you is important. One of the things that I've recognised amongst most or all successful investors I know is they actually don't try and do it on their own, Brett. They realise that they need a team around them.
I think you said it perfectly halfway through the session there, Michael, with getting that first 5 to 10 years right. So many people get it wrong, don't they? They fall into the traps that we've kind of mentioned. But if you've got someone there to keep you on track and take out the emotion and give you the evidence and the long-term fundamentals and the approach you need to take, you dramatically improve your chances of being successful. And our statistics show that, and our clients show that.
It definitely does. But at the moment, people are worried. People are thinking, is it the right time to buy? The banks are being difficult. There's problems overseas. Inflation's going to hang around longer. There's all the local issues as well. So what they're wondering is, should I get involved or not? They're looking at it the wrong way in my mind. I think they should be thinking, where's the market going to be in 5 years, in 10 years' time, rather than thinking what interest rate's going to be like in 6 months' time. And it's sometimes hard to get that perspective, especially with all these myths being thrown at you regularly on blogs, on podcasts, in the internet. So if you want to get a better perspective, why not have a chat with the team at Metropole? I'll leave a link in the show notes, and let's see what your options are. Brett, I know that you manage the national team at Metropole. You still see clients, so if people leave us their details and want to catch up with you, you're happy to do that?
Absolutely, yeah, most definitely.
Fantastic. Okay, thanks, Brett. Look forward to having a chat again with you real soon.
Appreciate it. Thank you, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to give you a number of reasons why you are not your thoughts. First of all, your mind is not a camera, it's a projector. Now look in the mirror. What do you see? You should see your face. But how would you describe it to somebody? Perhaps the person in the mirror is a young person filled with energy, yet also wise with age. The way we see and describe anything is different for each person. We've all got our own unique experiences, our past conditioning. Now, I read a while ago, Michael Neal wrote in his book, The Space Within, Finding Your Way Back Home, he said, we live in a world of thought, but we think we live in the world of external experiences. The mind's not a camera, it's a projector. We can't tell the difference between an image experienced in here and what's going on out there. And that confusion creates a lot of confusion. In other words, you see the world as you are, not as it is. Understanding what's right and what's wrong is ultimately a matter of perception, and that gives room for compassion. And compassion bridges conversations and relationships. So what I was getting at in this session is, you are not your thoughts. Let's look at it in a different way. You're constantly going through a system upgrade. If I asked you who you are, you'd likely start with what you do for a living. You'd maybe recite a list of past achievements, where you've been, what your values are. But who's the person behind those beliefs, behind those thoughts and ideas? Who are you now? Who are you now in this moment? This is important to ask because where you want to take your business, your profession, your investing, your life requires a different version of you to show up. Remember, your personal wealth will never outgrow your personal growth. Often we need to rip off our old belief systems that worked and build new ones that are relevant to where we want to head to. Because if you don't like system upgrades, you're going to be a bit like what happened with BlackBerry, and you're going to face extinction. So the second idea about why you're not your thoughts is because you're going to constantly be changing them. And the last thought I'd like to share with you in today's mindset session is, while pain can feel crippling, it could also be a stimulus for growth. I remember in a best-selling book, I think it was called Tools, the authors and psychotherapists who wrote it said something along the lines of, your experience of pain changes relative to how you react to it. When you move towards it, pain shrinks. When you move away from it, pain grows. If you flee from it, pain pursues you like a monster in a dream. And the more pain you can tolerate, the more you can learn. Now, I guess the same sentence would be true if you replace the word pain with fear. Pain and fear will surprise you if you're open to possibilities, without knowing how things are going to unfold. If things are tough right now, they won't last. And if things are good for you now, unfortunately, they won't stay good forever. The important thing to ask yourself is, what's the lesson in this? Because when you stop living in your thoughts, life becomes an experience. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports, my way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?